Okay, 11 o'clock. So let's get going. The guest this week is Stephen Rosser from NextEnergy Solar Fund. So we'll be talking to him in a minute. But first, as usual, I've got a bit of news to have a look at. Actually, a quieter week this week, and it might, I think, because people are sort of slightly shell shocked by what's going on in markets. But Polycap Financials came out today with some news about its planned reorganisation, and we'll talk about that. And then I just wanted to have a look at what has been going on since Trump announced the tariffs. So Polycap Financials first. As you can see, it's not too bad a chart. This is a 5-year chart, and this is quite relevant because basically every 5 years now it offers investors the chance to cash in their investment at asset value. And you can see that helps keep the discount relatively tight, and you can see that the discount has been trending in really for well over a year now in anticipation of this. It's quite a sort of good move, I think. And also, as we've talked about a couple of times recently, this idea that you can get out, but you only get out sort of once in a kind of market cycle, I think is the ideal way of doing these things, because then investors can actually sort of sit back and think, this is how it worked over the last cycle, do I want to run it for another one? And I think that's a far better way of doing it than doing it every year when you get this sort of situation where people go, oh, this is good. I can use this cash, it's kind of like a cash machine. So, decent sized fund, £560 million. And I'm hoping that it won't shrink too much, but we'll see what happens, and it may even grow. But obviously we're in slightly strange times. In terms of doing the job, it has beaten its benchmark over the period since the last tender. These are numbers from its website to the end of February, and you can see it's just ahead. It would have been a lot further ahead, but with some of the gyrations that have been going on recently, it's been quite hard to keep pace. I do think this is a decent set of managers in this sector, and really part of the whole argument for it is that it's a subcontract for what is a quite complicated sector to get your head around. It's obviously a global fund, and again, part of the attraction when it was first launched was that there's a quite limited pool of big financial stocks to invest in the UK. And so if you got money here and you want to get a more diversified exposure, you have to go overseas. If you're going overseas, you're going into all sorts of regimes, and just opens you up into far more different sectors. So it's quite a complex beast, and this is why you need a pool of expert managers actually managing the money for you. And you can see here, this is the end of February. Banks didn't make up the majority of the portfolio at the end of February. That is a change. It's a deliberate change that the managers made relatively recently, and you can read more about it in our notes. So what they've published today is that, I've put the 10th of, it was yesterday. They're going to publish a shareholder circular sometime before the end of May to basically cover all the votes off that needed to get this done. So there's a 100% tender offer. It'll come at about a 1% discount to NAV, but that's not, that basically is letting you get out at net asset value less costs, and that will all be wrapped up by the end of June. And at the same time, if people want to come in, that will be great, and they'll be able to expand it as well. So as I said, all a good move. There is a minimum size threshold, so if it did turn out that everybody ran for the exit, then and it turned out to be far too small, then they wouldn't keep it going, which is obviously quite sensible. There will be another one in 2030, and they're going to stick with the same investment approach that they've been using for the past 5 years, which has obviously worked. So in terms of what they are changing the fee, and that's coming down. So there's a new tiered fee. So assuming it does grow and gets stays above 500 million, then the sort of second tier now kicks in, so 0.65 on the balance. But more importantly, the way that it's calculated won't be just on NAV now. It'll be half on NAV and half on the lower of market cap and NAV. So that assuming that it tends to trade at a discount, will bring the fee down. And the other thing that a lot of people, I don't mind performance fees, some people have a problem with it. They are just getting rid of the performance fee, so that obviously makes the whole thing slightly more straightforward. And then the other big change is an enhanced dividend policy, and they announced this a little while ago, but they're just confirming it today. So they're going to pay 1% of the NAV out each quarter. So in the end, about 4% of NAV per annum, and that seems to be that sort of typical figure for these sorts of things. They were paying semi-annual dividends, so basically it becomes much more of an income stock. And financials actually is not a bad income generating sector. You get some decent dividends off these things. And so I think this does kind of make sense. You won't get the first of these until I think early 2026, though, because it kicks in with the new financial year. So that was Polycap Financials. Now I just, as I said, wanted to have a look at what Trump has done to markets. So first off, this is some numbers for individual markets. So you can see there the hardest hit things have been Argentina, Vietnam, China, and then some odd ones you might not expect, like Norway and Denmark. And I think that's because they've got a lot of energy. We'll see that in a second here. But included in this list are US small caps, the Russell 2000. So obviously that's hitting his own base. And also UK value stocks, which is slightly weird. But I think that, again, that might be because of the oil effect. And you can see that here, if you look at the first three sectors, this is looking at the global index, the All Countries World Index, and looking at the individual sectors within it. These are the hardest hit sectors. So energy equipment, energy itself, oil and gas are the three worst performing things. And the oil prices come right down on the back of this. And this is all on the back of an expectation that the global economy will slow down and there just won't be as much demand for energy or for oil on the back of this. We've got the ongoing hit to tech, which has come out of things like DeepSeek, but just the sell-off in the Magnificent Seven, that's sort of bit too. An obvious thing for trade is the air freight logistics, so that's come off too. But also, again, on the sort of global demand thing, you've got resources coming off commodities. And then the sectors that have been hit hardest since he came into power being biotech and pharma. And I do think there are starting to be some bargains in that kind of sector now. But obviously that's not directly related to what he's done with tariffs. And then if we look at the sectors that have been affected within our market, you can see here that you've got China and Vietnam selling off. So country specialist is really just Vietnam, and it's got one Korean fund in it. And they've been some of the worst affected trusts. But again, North American small cap, which is probably not what you intended to do. You've got the knock-on of China and Vietnam on Asia Pacific. The increased risk around things has caused a sell-off in growth capital stocks, obviously things that are related to the early stage companies trying to grow, which could be more difficult in a slowing economy, but I don't necessarily think it will be, because sometimes these are in new industries that will grow regardless. And actually, it's slightly counterintuitive because you've seen some odd moves in bond yields, but there's been nothing obvious that say that rising interest rates will have an effect here, other than perhaps people thinking that there's a long-term inflation problem now, and that means rates will stay high for longer, but we'll just have to wait and see on that. And then some of the other ones we've talked about already. Environmental, a bit like pharma and biotech, is another thing that's just been selling off since Trump came into power. And again, I do think the stocks in here are quite cheap. Obviously, we were talking to Impacts yesterday, and they were saying, a lot of their portfolio is looking relatively undervalued now. And then in terms of the individual trust moves, it's kind of the sort of things you'd expect to start off with. So Fidelity, China, International Biotech on the back of this pharma thing, and biotech growth there too. All the China funds basically. Vietnam Holding, Vietnam Enterprise. It's very unfortunate Vietnam Holding. They're actually trying to compete with me doing a seminar now. Obviously, I'm hoping you're watching this rather than them, but either way, you can catch us on catch up. So I would suggest maybe you go back and have a look at that one on catch up if you're watching this live, or vice versa. Slightly odd one in there is Hansa, but the discount on that has just got ridiculous. But there's nothing that anybody can do about it because the family that controls the company just don't seem to be bothered by the share price. And then reflecting this value sell-off, you've got the Aberforth geared value and income in there as well. So I thought just interesting. There's not much to conclude from that other than perhaps where you might find some bargains. And these are the widening discounts. And this was a slightly odd surprise to me because I just, it wasn't in the China things, the Vietnam things, the pharma stuff. It's a different set of stocks. Now, one of the things that seems to be happening as a result of all of this is that the IPO market shut down again. And obviously we were hoping that things like Klarna was basically about to start marketing an IPO and pulled it at the last minute. So that will all get delayed now. So that could make it harder for private equity companies to get exits. And that could mean that you don't get the NAV uplifts because the NAV uplifts tend to come when they get the exits and less on the back of what's going on in the economy. So you've actually got quite a lot of private equity funds widening out here. Those discounts were already too wide anyway. I think this is an overreaction, but nevertheless that does sort of explain why you've got ICG Enterprise, HotSeat Capital, Apex as well as Harvest in that list. And it kind of goes for Peters Hill too, because that's in unquoted asset management companies. And obviously they've got the geared effect then on the asset management companies of moves in markets too, so their AUM is going down. Then you've got the growth capital ones, and I say these don't really make sense to me. So Seraphim and Hydrogen One, again, they were cheap already. I don't think there's any real justification for why they've sold off. So they may be interesting. Digital 9, we know is a basket case anyway. Gore Street doesn't really make sense to me either. It was trading higher in anticipation of it getting the tax credit money from its new batteries that have come online in the States, so California and Big Rock and Dogfish in Texas. I still think that money's coming. There's been nothing to say that isn't coming, but we'll just have to wait and see. There is a risk around that. So maybe some interesting things to think about there. Definitely in the private equity space, I think there may be some bargains, but there we go. So that's enough from me. We are now going to talk to Stephen of NextEnergy Solar Fund. So thank you very much indeed for doing this. I've got some slides that we asked you to put together. So if you can just sort of tell us about the fund, please, and then if you've got any questions to ask Stephen, please do put them into the chat box on YouTube, and I will put them to him after he's finished talking. So over to you.
Fantastic. Thank you, James, and good morning, everyone. Really interesting overview that. Obviously, it's a very interesting time in financial markets at the moment, isn't it? But appreciate the opportunity to provide an overview of NextEnergy Solar Fund amidst all of that, and the opportunity that we see for investors to capture total returns through solar energy and energy storage in particular. So briefly introducing myself, my name is Stephen Rosser. I am the investment director responsible for NextEnergy Solar Fund. My role encompasses everything from designing and implementing the fund's investment strategies, engaging with our investors, to making sure the assets and our investments within the fund are performing as we will want them to. So the next 15 minutes or so, I'll cover a brief overview of the fund, an outline of our portfolio, the market opportunity that we see for investors at the moment, and also future opportunities that we see for the fund and how we're positioning it for growth. So let me introduce the fund itself. Where to start? So NextEnergy Solar Fund is a leading solar and energy storage investment platform. Ticker code is NESF. The investment objective is to provide shareholders with attractive risk-adjusted returns from a diversified portfolio of utility-scale solar and energy storage infrastructure assets. Through the portfolio, the fund offers investors an attractive dividend yield that's cash covered and significant prospects for future capital growth. It's a FTSE 250 company, and its investors are also playing a vital role in supporting the transition to a clean, affordable and secure energy system. So just take us on to the next slide, James. Just a little look at the dividend track record. NextEnergy Solar Fund has a very strong track record of delivering a reliable and attractive dividend for investors. Since coming to the market in 2014, the fund has paid out over £350 million in dividends. The current target, as you can see, is 8.43 pence per share. That represents a dividend yield of about 13% today, and we expect that to be 1.1 to 1.3 times cash covered for the financial year. If we take a look at the portfolio, we can understand a little bit more about how we generate that value. So the fund has 101 operating assets that are installed capacity around the world, predominantly in the UK. So combined operational capacity is 934 megawatts, and that's enough to power roughly 380,000 UK homes every year. Most of the assets, as you can see, are in the UK. There is a small amount of capacity in Italy, in Spain, and also in Portugal. On average, the fund's assets have a residual life of around 25 years. And over time, and as opportunities present, we expect the majority of the lifetime of the assets to be extended beyond that, in line with the evergreen nature of the fund. We've also invested $50 million in a private international solar fund called NextPower 3. So that investment is really important because it brings some of the higher returns from NextPower 3's international strategy into the NextEnergy Solar Fund perimeter. That's also allowed the fund to co-invest directly into assets in Spain and Portugal, alongside some of the largest infrastructure investors in the world. And as you can see, altogether, the gross asset value of the fund is around £1.1 billion. If we move on to the next slide, this is really just looking at the visibility that we have of future cash flows. And the reason we have such strong visibility is because the core of the fund's revenues are derived from RPI-linked government subsidies. Those account for just over half of the fund's revenues and provide a stable and really reliable set of core cash flows that underpin everything we do across the fund. The balance of revenues come from selling the clean electricity we generate to a few different types of buyers. That's mainly utilities, but also some major corporates and power purchase agreements. The power sales themselves are managed by a specialist energy sales desk within NextEnergy Capital as the investment advisor. The team uses its very deep knowledge of energy markets and energy trading to sell forward small clips of power and builds up a hedge position over time, as you can see on the wheel charts at the right-hand side of the slide. This approach allows the fund to lock in attractive prices where there's opportunities to do so, and also reduces exposure to wholesale price volatility in the front years. We're putting all of that together with the subsidy revenues that provides high visibility of future cash flows that support the work we do. If we move on, we can have a look at the illustration of how the cash flows translate into shareholder value by looking at the interim results for the 6 months to September 2024. So over that period, the portfolio generated 595 gigawatt hours of clean electricity and also realised a profit on the sale of some of its investments. Net of portfolio costs, the reported income, therefore, of the fund for the period was £45 million. And after the operating expenses and financing costs at the fund level, there were £37 million of net cash available for distribution. Of that, you can see £25 million was paid out as dividends. The surplus was reduced to reduce some short-term debt, buy back shares, reinvest in the health of some of the existing portfolio, and also some small investments towards future growth. So if we move on, I mentioned that we see a current market opportunity for investors, which makes sense to explore. So since coming to the market in 2014, NextEnergy Solar Fund has delivered total returns of around 40%. Every quarter, the fund publishes its net asset valuation, or NAV, using data from independent sources such as ONS, HM Treasury, third-party power market consultants, and a variety of others. Over the last 2 years in particular, we've seen a number of solar and storage assets being bought and sold in the market, including some successful asset sales by the fund itself. In each case, those assets were sold at a premium to the fund's NAV, which provides confidence that the NAV is a fair reflection of the value of the assets in the portfolio, and potentially even with opportunities to the upside, given some of the premium that we have seen and that within the fund itself we managed to achieve. By contrast, as you can see, the shares in the fund currently trade at a discount of around 30% to the NAV, which is in line with peers across the sector, but fundamentally not justified by reference to the sort of quality and the performance of the assets in the portfolio itself. So if the share price discount isn't driven by what's going on within the fund, which we don't believe it is, the question is, what is driving it? The short answer to that, in our view, is the combined impact of inflation and increases in the Bank of England base rate across the wider economy over the last couple of years. And for investment companies, those macroeconomic factors have led to compounding challenges on mainly 3 fronts. Firstly, typical holders investment companies, such as wealth managers, have had to liquidate quite a lot of their positions to fund redemptions by their underlying investors, who themselves have been trying to navigate the significant increases in mortgage costs and other wider cost of living challenges. Secondly, institutional investors have been steadily withdrawing capital from UK markets and investing elsewhere in the world. So it'd be really interesting, given what's going on with tariffs and other market volatility, to see how that evolves. And finally, over the last couple of years, as everybody will know, UK gilt rates have been increasing, and that's attracted some of the capital that might otherwise have looked to infrastructure investments for long-term, low-risk returns.
I'm not sure what happened there. We seem to have lost him. That's unfortunate, but while we work to get him back on again. There we go.
Not sure what happened there.
Yeah, no, don't worry, but we can see you again. You're all good.
Sorry about that. So just pulling all that together, the macro conditions have driven some types of capital away from small and mid-cap listed investment companies. And you might say that the investment company sector as a whole has rather fallen out of fashion. But although the recent tariff announcements by the US and the international response have increased uncertainty over the last couple of weeks, we are seeing signs in the underlying data that the tide should start to turn. So, for example, February's GDP growth data was more positive than expected, and the forecast immediately before that showed inflation heading back towards the Bank of England's target range. So whilst the tariffs position has been creating a distortion of late,
No, we can still hear you. It's all right.
Okay. So the underlying outlook supports a phased reduction of base rate, and over the medium term, a tightening.
Aha, there we go. I can see you again.
Fab. Sorry, for some reason I ended up backstage, but I don't know what that was about.
Very, very strange. Sorry. Okay.
Apologies, everybody. Where did we get?
I think
James?
we were talking about the capital recycling program. So I think we've talked about that. So obviously,
Yeah.
there's been a lot of progress on that, and there's more to do.
Yeah, absolutely.
And then
Well, maybe let's move on to the next slide.
Yeah.
Which is about so this is about outlook and opportunities for future growth. So we see, as I will have touched on, an enormous opportunity for further solar deployment and storage deployment in pursuit of the 2030 ambitions in the UK. And to put the fund in the best position to benefit from that opportunity, we've built within the fund itself a proprietary pipeline of near-term opportunities to put over £500 million worth of capital to work across a number of new solar and energy storage projects when the time and the environment is right. That pipeline itself is exclusive to the fund, and it's separate to the 10 gigawatt international pipeline of projects which the fund can also access through the relationship that we have with the development team at Starlight, which exists in the rest of the NextEnergy group. So the combination of, I was pulling everything together, the combination of the carefully curated portfolio of assets that we currently have, which are performing very resiliently, the supportive policy environment, and the underlying economic outlook.
Going again.
Did I drop out again there?
You did, just very briefly.
No,
Sorry.
I was just saying, pulling everything together. So really resilient portfolio, supportive policy environment, underlying and improving economic outlook for the sort of medium term, albeit there's some uncertainty now as a result of the tariff situation. And then the opportunity set that we have within the fund, we think all of that together creates a really exciting opportunity and future for the fund. And of course, the team and I at NextEnergy Capital are very highly motivated to start unlocking all of that, to harness that potential and drive significant further value for investors over the years ahead. So I think that sort of brings the presentation to a close. But obviously very happy to take any questions, and technology will play ball. And James, if I hand back to you.
No, thank you very much, Stephen. That's good. And we'll, apologies for those who are watching it live. We'll sort out the recording afterwards to remove some of the glitches. So I think there's sort of a big question here, which is kind of alludes to what you've just been talking about, in terms of what the fund is for. So you've built a large portfolio of energy producing assets, and that's great. But in terms of trying to drive towards net zero, the important thing is to get this pipeline built. So is recycling the capital the real focus now, or do you have to be careful to keep generating the income? Is that more of a focus?
The focus is actually a combination of the two of those things, and it's about getting the balance right between driving that sort of yield performance, but also harnessing the growth potential and driving capital into new assets over time that deliver that sort of total shareholder return perspective. It probably is an evolution of how the sort of investment companies would have looked at their role and function in life. But I think it's a natural point now for the fund in its life cycle, but also looking at the opportunity that exists around it in the UK market to be updating its focus to deliver all those things. So it's fundamentally about getting the balance of capital allocation right across all of the different interests.
When you're thinking about making the investment now, I mean, obviously there's debt and some of the underlying structures of these things. Is the level of interest rates changing the way the deals are structured at the moment?
It definitely has an influence. I mean, as you'll have seen across the fund, that our most recent activity has been to sell down some of the investments, which we were amongst the first in the market to be investing in those types of assets anyway, and therefore sort of relatively unique in our ability to realise those investments in fairly short order, sort of post. So investing pretty quickly post subsidies being reduced or cut for some of them. Obviously we have built and made operational our first energy storage asset in Camilla, which is up in Scotland over the last couple of years. Really important development for the fund. We're not actively in construction at the moment on any further assets, but what remains important for us is the flexibility around that sort of near-term pipeline that I've touched on, which is a combination of domestic and international solar and storage, to make sure that when the time is right, we can deploy capital into those. But right now, the most attractive investment, investment that is hard to beat, is actually buying back in the shares of the fund. To be really clear, we don't see that as a silver bullet at all in terms of closing the discount to NAV, but it is and it's an important part of the investment landscape, and therefore that's where the focus has been of late, alongside reducing exposure to the sort of the unhedged portion of the debt, which is our short-term debt that exists in RCF, and as I mentioned, that's been downpaid by net 46.3 million over the last 18 months.
In terms of the buybacks, there's a question here about the volume of them. Are you constrained by the liquidity of the underlying shares, or are you constrained by the amount of capital available to do buybacks at the moment?
Again, that's a question about getting the balance right, really. So one of the things that we have thought very carefully about is the timing, sizing, and shaping of buyback, and definitely believe that little and often, and being a constant presence in the market is the right way forward. There is, as I say, limited. It's very, very hard to disaggregate the impact of a buyback program from other factors that affect share price. But we think it's important to be just have a constant underlying regular presence in the market rather than doing anything big bang. But we do obviously have to navigate the investment policy limits around gearing and other things as part of getting that balance right.
Yeah, if that makes sense. You've got these exposure to projects around the world. How do you actually manage the operations in different parts of the world and sort of keep a handle on what's going on in these different places?
Yeah, it's a great question. So actually the team, the investment is in a private equity fund called Next Power 3, which itself is actually managed by NextEnergy Capital, a different team and segregated from the team that I run looking after NextEnergy Solar Fund. But the thing that should provide investors with a lot of confidence is it's the same quality and caliber of people, the same relentless focus on driving value for investors that is applied across all of everything we do, including in that international fund. So in terms of the NextEnergy Solar Fund team, we don't directly manage that, but of course we do oversee the reporting, the data. We ask the challenging questions about what's going on in that fund as it is deploying, but it is obviously making great strides in achieving its own ambitions in terms of capacity build out around the world against its I think 1.7 gigawatt operational target. And those guys are doing really well. They're bringing all of that to fruition. At some point over the next handful of years, that fund will come to an exit point and a liquidity event for that vehicle, which in turn should bring those returns into the fund and give us opportunities therefore to do something interesting for investors at that point in time, whether that be a liquidity event for NESF or investment into other opportunities remains to be seen. But all of that further down the line.
Great, thank you. There's a question about the visibility. So actually, there's a couple of questions we can talk to on the slide, but think about the visibility first. So generally, where do you see power prices going? I mean, I know you use external forecasters to help you do that, but what do your take on it? Where do you think we're going? And also, to what extent are you seeing more and more corporates using power purchase agreements to lock in power prices in the future?
Yeah, both great questions. Let me take the second one first, and then I'll come back to the long-term outlook for power prices. So, in terms of corporate use of corporate PPAs, I think that's still an evolving space. We definitely see conceptual appetite amongst corporates for that, and a range of types of interest, from wanting to own the generation themselves to wanting to have medium to long term contracted arrangements with generators. They're quite hard to put together. It's quite a complicated risk allocation, and therefore they do tend to take quite a long time to bring to fruition. And I think that in itself is probably slowing down or constraining deployment and the number of PPAs you see being signed in terms of volumes at the moment. But over time, I would expect that to pick up, both as we come to a more market norm in terms of risk allocation, and there's a lot of education that is needed amongst the community in terms of coming to an alignment about how risk allocation can work, and then that will achieve clarity and simplicity and sort of speed up execution, which all of which will help. So I do see it evolving and positive movements in that space. But it's still relatively emergent, I would say. In terms of power prices themselves, obviously we use a blend of the main advisors. I don't know if you can still hear me.
Yes. Yeah.
Okay, fine. Yeah. So we use a blend of the main advisors and fold that into the NAV. What we see is power pricing sort of settling out at a higher level than it was previously, and it's a relatively flat trajectory, which is quite a difference from how some people might have been assuming the sort of hockey stick curve in years gone by. We in the NAV don't fold in any house views into power pricing, but I think we do obviously have perspectives, and I think we see opportunities to the upside certainly for the next 5 or 10 years, and that it pays to be a generator on the system right now, because whilst there is an enormous opportunity for the fund in terms of the Clean Power 2030 build out and what have you, the challenges that exist in deploying new assets on the grid generally, and therefore the assumptions that might be being made about how much of that capacity is going to be built, I think will ultimately deliver a slower deployment trajectory for UK overall, or the GB market overall. All of which means, as I say, it pays to be a generator on the system while that's happening. So we see opportunities to the upside relative to the curves, but again, we don't fold those into the NAV.
Great, thank you very much. There's a question specifically about tariffs. I mean, do they have any sort of direct practical impact on what you're doing, other than the sort of bigger, wider impact on global economy and sort of how that's directly? No, or very limited. So it's almost too early to comment, if you like, because that situation is obviously still evolving, where we've got tariffs and then we haven't got tariffs and what have you. So that the sort of 90-day pause in itself is interesting, although you'll all have seen China's news this morning about increasing up its rate against its tariff rate for US
exports to 125% to match. So the real impact for NESF is about the macro there.
Right, we have you again. Last time, I think. Cool. Good.
I don't know what's going on with it.
There's a couple of questions, and I think it is probably key given the size of the yield, about the sustainability of the dividend. And I think you've talked to the visibility on income and things, but can you sort of just reiterate how comfortable you are with how sustainable the dividend is, please?
Yeah. So as I say, that sort of visibility of future cash flows is really underpinned by the core component of the subsidies, and then the work we do to hedge out the power at attractive prices. Ultimately, what the dividend looks like going forward is a question for the independent board of directors. We work obviously very, very closely with them. And again, it's about getting the balance right between making sure that we're delivering the yield performance that in one group of investors want, and delivering total return that other groups of investors are looking for. And also, well, I suppose it is ultimately about getting that balance right, isn't it? I suppose there isn't much more to say beyond the.
No, I don't want to
visibility that we can. Yeah,
exactly.
Yeah, very, very difficult. But we expect this year's dividend to be 1.1 to 1.3 times covered, as I touched on. That's very healthy cover. I suppose there is a point about in terms of that yield, it is not being recognised in the share price, and therefore there is no reward for maintaining that high level of yield at the moment. But all of that needs to be sort of factored into the round in the board's deliberations, which obviously they work very, very diligently through, and will be doing so over the months ahead.
One last question, and again, maybe you just say, "Oh no, we've lost him." I think we'll call it a day there. Thank you very much for everybody for patience with this. And I'm sorry we had a few connection issues there, but there we go. I was just saying, thanks, Stephen. Thank you. I think we'll just sort of call time on it there if it's okay.
Yeah, I don't know if it's at my end, but if it is, apologies for.
Do not worry. Do not worry. But thank you for this, and we'll tidy up the actual video before we republish it tomorrow. But thanks for your time today, and thanks for asking the questions. So
pleasure, no problem. Speak to you soon.
Next week is Good Friday, but before we get there, one thing that I'd like you all to have a look at, please. There's a link on our website to the AIC's My Share My Vote campaign petition. I don't know how effective this is going to be in terms of a strategy in trying to get the Parliament to change the law. But nevertheless, please do go and you go through the link and sign it if you can. Probably more effectively, if you just make a noise, write to your MP or something, that would probably help. The point, if you go back and listen to the interview that we did with Richard Stone, he explains it all there. But in a summary, we just want the platforms to be forced to allow investors to vote simply and easily, so that we get much greater participation in terms of votes at AGMs and things, as well as in the bigger issues like the sort of cyber stuff. So there's that. As I say, we'll be on holiday next week as Good Friday, but the week after that is the next of our panels, and we'll be talking to 3 interesting investment managers in the property sector, talking about when REITs might rebound. So have a good break, have a good Easter, and we'll see you then. Thank you very much for your time this morning.